This is Chris Latham, Deputy Managing Editor at Wealth Solutions Report. With me today is David DeVoe, founder and CEO of the M&A consultancy DeVoe and Company. David, it's great to have you here with us.
Hey, Chris, it's a pleasure for me. Thanks for having me.
David, what has been the overall trend in M&A activity for the RIA space so far in 2023 in terms of deal volume and deal valuations?
Yeah. So, it's interesting. 2022 was the ninth successive record year of M&A activity. So, it almost got boring where reporters would call and say, okay, I'm guessing M&A is up yet again. And I'd say, yeah, it is. But things changed. Things changed in Q4 of last year. And we saw a compression, pretty significant compression, about a 20% decline. January and February didn't snap out of it. We're still down. As a matter of fact, it looks like, Q1, we're a couple weeks away from the end of the quarter at this point, but Q1 is likely to be soft, maybe in that 5 to 10% range. So yeah, it's interesting to be living through a bit of a slowdown right now.
How has Federal Reserve interest rate hikes and stock market performance impacted these trends? And are any other major factors at play?
Well, you've touched on the two biggest trends that really have been affecting things, and by the way, there's more beyond that. There's the U.S. economy, there's the global economy. There's inflation, there's this human capital challenge that is very acute for advisors, and gee, we even have wars going on in parts of the globe. So, but those two that you touched on are pretty important in today's environment. I've been doing this for coming up on 20 years now, and the volatility, either continued period of volatility or significant declines in the stock market ends up impacting REA M&A activity. It was almost surprising that for the bulk of 2022, we didn't see much of a slowdown. Even with interest rates going up, we didn't see a slowdown until, it all sort of came together in Q4. So, we have an interesting environment. Um, Interest rates are up, and that's a real cost, right, to buyers. So it not only makes M&A more expensive or an acquisition more expensive, the cash flow of these firms are down to a degree as well. So it's an interesting dynamic where most buyers have not blinked and compressed the multiples they're paying for RIAs, which, by the way, it has been at a record high for about 3 years straight now. But the cash flow of the firms are down because of exactly what you talked about. The stock market's down, revenues are down, and consequently, that compresses the EBITDA and valuations being down a bit. So, um, long story short, today's buyers are sophisticated management teams, and they're backed by smart private equity, and they're being smart about how they do valuations and deal structure to really try to incent an optimal transaction coming together in today's environment.
Excellent. Now, what types of acquirers have been most active so far in 2023? And by that, I mean RIAs, broker dealers, banks, consolidators. Which of those have been most active? And what types of sellers have they been most often targeting? And why have they been doing that?
Yeah. So on the buyer side, for the last, probably nearly 10 years or so, the consolidators, and we just define that as someone who has their business model predicated on going out and making mergers and acquisitions, which, by the way, makes it a dynamic set. The firm business models are evolving over time, but you can imagine the usual
Mm.
suspects, the major acquirers. They've really been the dominant force in this industry. They rarely tick up above 50%. They're typically in the 40s, and that's exactly where they are today. In late 2021 and 22, they started trending above 50%. But in today's environment, year to date, it's about 44% of the acquirers in the marketplace. The second category has been consistent as well. It's RAAs. They're buying about a quarter of the firms in the marketplace. And then we see, the other category, which can run a pretty wide gamut, and it can include, banks and IBDs. Private equity falls in that category. Matter of fact, there was one year that a restaurant, believe it or not, a chain of restaurants bought an RAA as well. So the other category is another dynamic as well. So yeah, on the M&A side, we see these larger acquirers being the dominant force, and REAs, really wanting to get into the space as well. In terms of the seller, there's been some interesting trends. If we go back to the COVID days, when COVID hit, the smaller firms stopped doing mergers and acquisitions, but the larger firms actually ramped up. They increased right away the number of sellers. Um, so we've seen this domino effect that DeVoe and Co calls it, happen before in the past, and it's really a dynamic where you take your typical REA where the leadership team is contemplating selling the firm, and suddenly they see their big brother or sister sell, and it creates proof of concept, and they're like, okay, I should sell too. So that's exactly what happened during the COVID days, where $5 billion plus firms started selling in greater quantities. Then we went through this surge of $1 billion plus firms, this surge of half billion, and then down to 100 million or so. So these dominoes falling. We started to see it spike back up where the $1 billion plus players were selling toward the end of last year, and that's really sustained itself. Where some of the some of today's sellers that have dialed it back have been the smaller REAs. So it'll be interesting to see what happens. In today's environment, DeVoe and Company hasn't seen a slowdown in M&A activity in our pipeline. The major consolidators haven't seen a slowdown in terms of their pipelines. So what we believe is happening is either smaller firms and or firms backed by private equity. I'm sorry, either smaller firms or firms that aren't hiring an investment banker, I should say, are the ones that seemingly are dialing it back, because most of the major players in today's space don't see a slowdown occurring.
Interesting. So, what size of acquirer is doing most of the deals?
Yeah, so it's the big ones, the big ones. So the major acquirers are not only accounting for 44% of the transactions in the marketplace, but if you put it on an AUM level, it's probably close to 2x that number. They're going after the bigger deals, so they're really the most active in this space now. From development company perspective, or my own personal perspective, perhaps I say, we want to see a variety of different buyers in the marketplace. When I think about the REA community, I want a firm when it's ready to sell to have a wide variety of options. Now, the good news is there's a wide variety of consolidator options. You can do someone who's going to integrate you into the organization. You can sell to someone who's going to allow you to retain full independence, more or less. And then there's everything in between. So the good news is for the mega acquirers, there's a lot of options out there, but I like to see, sort of medium and large acquirers as well. And fortunately, we saw that number tick up a little bit year to date. We've seen an increase in the number of first time acquirers. But that's something that we think makes a healthy marketplace, is you have, medium, large, and mega firms that are acquiring at any given time.
Now, let's turn to private equity. Have private equity firms been showing the same level of interest in backing wealth management M&A? And how are private equity firms evaluating potential deals now?
Yeah, yeah. So private equity has had quite an effect on this space, and I think it will for some time to come. Each year, private equity interest seems to increase. At DeVoe& Co, we actually had to start charging fees for the first conversation with me, just because so many private equity firms, want to pick our brain, et cetera. And a lot of them become clients. We represented, New Mountain Capital, and finding a transaction, introduced them to Homrich Berg, and negotiated that deal on behalf of New Mountain Capital. We've introduced Abry to Beacon Point. So we traffic in that space every day, and it's important because it's a dynamic part of the marketplace. What we've seen is years ago, maybe 10 years ago or more, private equity would invest in a business plan. Focus Financial Partners or United Capital are good examples of a smart guy with a business plan who needed some capital. More recently, they've invested in platforms, 3, 5, $10 billion plus REAs, where they're making an acquisition of that firm, and they're also them being a partner to help them grow aggressively through acquisition. Um, Many people are concerned about private equity. When I started in this industry, 18, 19 years ago, it was perceived as like a boogeyman. Oh, well, it's private equity, so there's only 7, 8, 9 years on that that fund, and then they have to sell, and it was like, and then the company falls off the earth. The earth is flat, and they're going to fall off the earth. You know, wait a sec. They're going to sell that asset, hopefully at a great appreciation, which historically has occurred. But they'll either take it private, which is less common than selling it to another private equity firm and another one. And that can be really healthy. Each private equity firm has their own unique set of capabilities beyond just a bag of money. So it's not unusual. It's been very common in this marketplace to see private equity sell from one to another without negative implications to the firm. This isn't like barbarians at the gate or chainsaw Al. If you're my age, where you see these firms come in and they buy them, they lever up debt, they fire a whole bunch of people, they turn the cost structure inside out, and then they go to town. In this industry, we need people. So as they're doing transactions, they're not jettisoning, employees to optimize or maximize the cash flow. You know, they're going to make these acquired firms grow faster. And when you grow faster, you're going to need more people running those companies. So it's been an interesting dynamic. I'll make two other points. Sorry for rattling on here, but it's an important topic you touched on. One, they're contributing to what we see as the consolidation at the top of this industry. So there's about 2 dozen, we call them meta RAAs. We've called them that for a couple of years now. Firms that are using the most uh, they're using the most effective tactics available to run their companies. Meta also is Greek for sort of comprehensive, et cetera. But these are firms that are really shaping the industry. They're doing things differently. They have sophisticated management teams. They're investing aggressively. So the marketplace is changing within the REA space. Now, it's not going to force everyone to have to sell, but the competition is going to change and become more important. And they're also pulling up valuations. There's this arbitrage opportunity. They're doing a great job of growing these firms and making them more profitable. And as you do that, you can pay higher valuations. So that's really what's driven up the valuations of this industry the last 3+ years.
Okay, fascinating, truly. And now let's turn to sub acquisitions. 2022 was a
Yeah.
record year for sub acquisitions. How is that shaping
Yeah.
up in 2023? And what are some unique considerations for firms involved in sub acquisitions?
Yeah, yeah. So let's define terms first. I was on a panel last week where they defined it a little differently. So let's just make sure we're all clear. We define sub acquisitions where a firm has taken on an equity partner, so they've sold, for lack of a better word, and now their affiliates, people that are part of that platform, are now going out and making acquisitions on their own. So Focus is a great example of that. They've acquired close to 100 firms over the last decade and a half or more. And now their affiliates have Focus's capital, Focus's M&A acumen to go do transactions. Now, what's interesting too is it enables a consolidator like Focus to have tentacles. Sounds negative, but tentacles throughout the RE community, and then smaller deals can get done. So some of these larger acquirers only want to acquire firms that have half a billion or a billion or more. Um, but the firms they acquire are happy to acquire, 200 million or 100 or even less than 100 all day long. So these sub acquisitions have been increasing and that's actually what can drag down it's not a bad thing, drag down the average um, size of an REA in a given year because some of these firms are becoming better and better at getting transactions done. So yeah, we it tends to be a more volatile number, but the last couple of years we've seen these sub acquisitions increase.
All right, now let's open the crystal ball. It's early, but your
Yeah, yeah.
view on full year 2023 as it concerns buyers and sellers in the RIA M&A space. What do you see?
Yeah, yeah. Well, I think, buckle up. I think it's going to be interesting. We talked about it being boring. So we have a couple months of decline. I mean, we watch this on a weekly basis, of course, of DeVoe and Co. and reported on it in our quarterly deal book. But it's been very volatile, unusually volatile for what we've seen in this industry. And you touched on at the beginning of the call, like some of these dynamics that are going to be affecting M&A activity. So we've done a couple surveys. One, I just surveyed all the acquirers in the marketplace. Know them all well. A lot of them are friends of mine by now. And I said, hey, M&A is slowing down. This is back in Q4 when we saw M&A drop dramatically. I'm like, we don't see a slowdown in our pipeline. Do you see a slowdown in your pipeline? And most of them said, no, we actually surveyed them. Most of the pipelines are actually getting bigger. So, so it seems like a lot of the transactions should continue to be solved, but we also did a survey of all RAAs late last year, mid-year last year, and a much larger percentage than usual said we're going to see an M&A slowdown. So my crystal ball, I think it's going to be interesting to watch. Grab some popcorn because I think it's going to be up. I think it's going to be down. Might go up again. So it's going to be much more volatile than we've seen over the last several years. But I think overall, maybe 2023 is the first down year we have in 9 years. Right now we're 10% or so below where we were last year. Maybe that sustains itself. But I think looking further out, just the structural underpinnings of the REA industry, is likely to drive M&A up over the next, 2, 3, 5, even 7 years. That's succession planning. We have a succession planning issue. I say it's an issue because most advisors, the owners are aging, but very few have put succession plans in place, and that's going to force many to sell externally. But the other driver is, people joining a larger organization to have the benefits of scale. Um, this industry is just wired to take care of their clients. It's also driven by a lot of control freaks. All kidding aside, people that launch companies are control freaks. So there's this tension between wanting to do everything and control the company versus joining a larger firm that can provide greater set of services in many cases, have greater specialization, can reduce administrative or operational headaches. So those two major factors, succession planning and the power of scale, is likely to drive up M&A over the midterm.
Excellent. Well, based on that landscape, how can buyers and sellers in the RIA M&A space best position themselves for success?
Yeah, yeah. So you heard me earlier. I'd love to see more REA buyers come in, but you got to be serious. Mergers and acquisitions is extremely complicated. It takes a lot of time and energy. So clearly you can hire a firm like DeVoe and Co. We help buyers, we help sellers, we help with mergers as well. But some folks want to do it themselves, and that's great. I'm happy to give DIY advice, DIY. So, what I'd say is take it really seriously. Think through, okay, you can't just stumble into the M&A game. You want to be very thoughtful. You want to have clarity and conviction around what your story is. How are you going to differentiate yourself from all these ninjas in the marketplace? You want to be very dialed into what your target client, target profile acquisition is. How are you going to, make sure you don't waste time and energy talking to too many firms? You also really want to think through all the different components. How are you going to do valuation? What does that look like? What's your deal structure? Don't say, oh, we'll figure it out. We're happy to get flexible. You need clarity and even conviction around what your deal structure is. Once you acquire them, what if they have a different fee structure? What if they compensate their people differently? Who's going to report into who? What does that look like? How do you fold these organizations together? The more answers you can really have in place, you simply have to have in place, is going to better prepare you to go into the marketplace. So from the buyer's side, just really leaning in hard, and getting all those ducks in the row. From the seller side, you know, when I was young, I bought my first house. My dad's like, "Hey, you got to paint this thing, clean it up, rip up the carpet, shine up those hardwoods. You not only enjoy it, but then when it's time to sell, it's just going to be worth more money." So, for those that might be pausing, they're like, "Hey, Dave mentioned that, right now valuations might be compressed due to cash flow. I'm not in an urgent rush here." Matter of fact, so many of our sell side clients say, "Ah, you guys are ninjas. Like, I wish we hired you to clean up our business for 2 years before we went and sold it. We now see it'd be worth 50% or more in valuation." So I'd say again, do it yourselfers, ultimately your ability to, make your firm grow faster is the most important thing you could do. For every 1% you grow faster on a sustainable basis, you might see a 6 or 7% increase in the value of the firm. You also want to optimize valuation. I didn't say maximize. I said optimize. You want to, the cash flow, the profitability of the firm. My bad. You want to make sure you have appropriate margins for your company. You want them high, but you don't want them extremely high. And then you want to mitigate risks. You know, have your non-competes, non-solicits in place. Um, You want to make sure you have ongoing performance reviews of your staff. Believe it or not, that helps with retention. You don't want people leaving before the transaction. There's 48 different risk factors that we look at for a firm. So your ability to optimize the growth of the company as well as the profitability and minimize the risks associated with the firm is how you're going to optimize the value of your company.
Excellent. Fantastic, David. Thank you very much for your time. We greatly appreciate it.
Oh, pleasure. Thanks for having me, Chris.